A bank is a financial institution that accepts deposits from the public and creates credit. Lending activities can be performed either directly or indirectly through capital markets. Due to their importance in the financial system and influence on national economies, banks are highly regulated in most countries. Most nations have institutionalized a system known as fractional reserve banking, under which banks hold liquid assets equal to only a portion of their current liabilities. In addition to other regulations intended to ensure liquidity, banks are generally subject to minimum capital requirements based on an international set of capital standards, known as the Basel Accords. Banking in its modern sense evolved in the 14th century in the rich cities of Renaissance Italy, but in many ways was a continuation of ideas and concepts of credit and lending that had their roots in the ancient world. In the history of banking, a number of banking dynasties, notably the Medicis, the Fuggers, the Welses, the Barenbergs and the Rothschilds, have played a central role over many centuries. The oldest existing retail bank is Banca Monte dei Paschi di Siena, while the oldest existing merchant bank is Berenberg Bank. History. Banking began with the first prototype banks of merchants of the ancient world, which made grain loans to farmers and traders who carried goods between cities. This began around 2000 BC in Assyria and Babylonia. Later, in ancient Greece and during the Roman Empire, lenders based in temples made loans and added two important innovations. They accepted deposits and changed money. Archaeology from this period in ancient China and India also shows evidence of money-lending activity. The origins of modern banking can be traced to medieval and early Renaissance Italy, to the rich cities in the north like Florence, Lucca, Siena, Venice and Genoa. The Bardi and Peruzzi families dominated banking in 14th-century Florence, establishing branches in many other parts of Europe. One of the most famous Italian banks was the Medici Bank, set up by Giovanni di Bicci de' Medici in 1397. The earliest known state deposit bank, Banco di San Giorgio, was founded in 1407 at Genoa, Italy. Modern banking practices, including fractional reserve banking and the issue of banknotes, emerged in the 17th and 18th centuries. Merchants started to store their gold with the goldsmiths of London, who possessed private vaults, and charged a fee for that service. In exchange for each deposit of precious metal, the goldsmiths issued receipts certifying the quantity and purity of the metal they held as a bailee. These receipts could not be assigned. Only the original deposit could collect the stored goods. Gradually the goldsmiths began to lend the money out on behalf of the depositor, which led to the development of modern banking practices. Promissory notes were issued for money deposited as a loan to the goldsmith. The goldsmith paid interest on these deposits. Since the promissory notes were payable on demand, and the advances to the goldsmith's customers were repayable over a longer time period, this was an early form of fractional reserve banking. The promissory notes developed into an assignable instrument which could circulate as a safe and convenient form of money backed by the goldsmith's promise to pay, allowing goldsmiths to advance loans with little risk of default. Thus, the goldsmiths of London became the forerunners of banking by creating new money based on credit. The Bank of England was the first to begin the permanent issue of banknotes. In 1695, the Royal Bank of Scotland established the first overdraft facility in 1728. By the beginning of the 19th century, a bankers' clearing house was established in London to allow multiple banks to clear transactions. The Rothschilds pioneered international finance on a large scale, financing the purchase of the Suez Canal for the British government. Etymology. The word bank was borrowed in Middle English from Middle French banque, from Old Italian banca, meaning table, from Old High German bank, bank. bank bench. Counter benches were used as makeshift desks or exchange counters during the Renaissance by Jewish Florentine bankers, who used to make the transactions atop desks covered by green tablecloths. Definition. The definition of a bank varies from country to country. See the relevant country pages under for more information. Under English common law, a banker is defined as a person who carries on the business of banking, which is specified as conducting current accounts for his customers, paying checks drawn on him, her, and collecting checks for his, her customers. In most common law jurisdictions there is a Bills of Exchange Act that codifies the law in relation to negotiable instruments, including checks, and this act contains a statutory definition of the term banker. Banker includes a body of persons, whether incorporated or not, who carry on the business of banking. Although this definition seems circular, it is actually functional, because it ensures that the legal basis for bank transactions such as checks does not depend on how the bank is structured or regulated. The business of banking is in many English common law countries not defined by statute but by common law, the definition above. In other English common law jurisdictions there are statutory definitions of the business of banking, a banking business. When looking at these definitions, it is important to keep in mind that they are defining the business of banking for the purposes of the legislation, and not necessarily in general. In particular, most of the definitions are from legislation that has the purpose of regulating and supervising banks rather than regulating the actual business of banking. However, in many cases the statutory definition closely mirrors the common law one. Examples of statutory definitions. Banking business means the business of receiving money on current or deposit account, paying and collecting checks drawn by or paid in by customers, the making of advances to customers, and includes such other business as the authority may prescribe for the purposes of this Act. Section 2. Interpretation. Banking business means the business of either or both of the following: receiving from the general public money on current deposit, savings or other similar account repayable on demand or within less than, or with a period of call or notice of less than that period, paying or collecting checks drawn by or paid in by customers. Since the advent of FPOS, direct credit, direct debit and internet banking, the check has lost its primacy in most banking systems as a payment instrument. This has led legal theorists to suggest that the check-based definition should be broadened to include financial institutions that conduct current accounts for customers and enable customers to pay and be paid by third parties, even if they do not pay and collect checks. Banking. Standard business banks act as payment agents by conducting checking or current accounts for customers, paying checks drawn by customers on the bank, and collecting checks deposited to customers' current accounts. Banks also enable customer payments via other payment methods such as automated clearinghouse wire transfers or telegraphic transfer (FPOS), and automated teller machines. Banks borrow money by accepting funds deposited on current accounts, by accepting term deposits, and by issuing debt securities such as banknotes and bonds. Banks lend money by making advances to customers on current accounts, by making installment loans, and by investing in marketable debt securities and other forms of money lending. Banks provide different payment services, and a bank account is considered indispensable by most businesses and individuals. Non-banks that provide payment services such as remittance companies are normally not considered as an adequate substitute for a bank account. Banks can create new money when they make a loan, New loans throughout the banking system generate new deposits elsewhere in the system. The money supply is usually increased by the act of lending, and reduced when loans are repaid faster than new ones are generated. In the United Kingdom between 1997 and 2007, there was an increase in the money supply, largely caused by much more bank lending, which served to push up property prices and increase private debt. The amount of money in the economy as measured by M4 in the UK went from £750 billion to £1,700 billion between 1997 and 2007. Much of the increase caused by bank lending. If all the banks increase the lending together, then they can expect new deposits to return to them and the amount of money in the economy will increase. Excessive or risky lending can cause borrowers to default. The banks then become more cautious, so there is less lending and therefore less money, so that the economy can go from boom to bust. Has happened in the UK and many other Western economies after 2007. Range of activities. Activities undertaken by banks include personal banking, corporate banking, investment banking, private banking, transaction banking, insurance, consumer finance, foreign exchange trading, commodity trading, trading in equities, futures and options trading, and money market trading. Channels. Banks offer many different channels to access the banking and other services. Automated teller machines, a branch in a retail location, call center, mail. Most banks accept check deposits via mail and use mail to communicate to the customers, e.g., by sending out statements. Mobile banking is a method of using one's mobile phone to conduct banking transactions. Online banking is a term used for performing multiple transactions, payments, etc. over the Internet. Relationship managers, mostly for private banking or business banking, are often visiting customers at the homes or businesses. Telephone banking is a service which allows its customers to conduct transactions over the telephone with automated attendant, or when requested, with telephone operator. Video banking is a term used for performing banking transactions or professional banking consultations via a remote video and audio connection. Video banking can be performed via purpose-built banking transaction machines, or via a video conference-enabled bank branch. Clarification. DSA is a direct selling agent who works for the bank based on a contract. Its main job is to increase the customer base for the bank. Business models. A bank can generate revenue in a variety of different ways, including interest, transaction fees, and financial advice. The traditionally most significant method is via charging interest on the capital it lends out to customers. The bank profits from the difference between the level of interest it pays for deposits and other sources of funds, and the level of interest it charges in its lending activities. This difference is referred to as the spread between the cost of funds and the loan interest rate. Historically, profitability from lending activities has been cyclical and dependent on the needs and strengths of loan customers and the stage of the economic cycle. Fees and financial advice constitute a more stable revenue stream, and banks have therefore placed more emphasis on these revenue lines to smooth the financial performance. In the past 20 years, American banks have taken many measures to ensure that they remain profitable while responding to increasingly changing market conditions. First, this includes the Gramm-Leach-Bliley Act, which allows banks again to merge with investment and insurance houses. Merging banking, investment, and insurance functions allows traditional banks to respond to increasing consumer demands for one-stop shopping by enabling cross-selling of products. Second, they have expanded the use of risk-based pricing from business lending to consumer lending, which means charging higher interest rates to those customers that consider to be a higher credit risk and thus increased chance of default. on loans. This helps to offset the losses from bad loans, lowers the price of loans to those who have better credit histories, and offers credit products to high-risk customers who would otherwise be denied credit. Third, they have sought to increase the methods of payment processing available to the general public and business clients. These products include debit cards, prepaid cards, smart cards, and credit cards. They make it easier for consumers to conveniently make transactions and smooth the consumption over time. However, with convenience of easy credit, there is also increased risk that consumers will mismanage their financial resources and accumulate excessive debt. Banks make money from card products through interest charges and fees charged to cardholders, and transaction fees to retailers who accept the bank's credit and/or debit cards for payments. This helps in making profit and facilitates economic development as a whole. Products: retail banking, savings account, recurring deposit account, fixed deposit account, money market account, certificate of deposit, individual retirement account, credit card, debit card, mortgage, mutual fund, personal loan, time deposits, ATM card, current accounts, checkbooks, automated teller machine, business banking, business loan, capital raising, mezzanine finance, project finance, revolving credit, risk management, interest rates, commodities, derivatives, term loan, cash management services, credit services, capital and risk. Banks face a number of risks in order to conduct the business, and how well these risks are managed and understood is a key driver behind profitability and how much capital a bank is required to hold. Bank capital consists principally of equity, retained earnings and subordinated debt. Some of the main risks faced by banks include credit risk, risk of loss arising from a borrower who does not make payments as promised. Liquidity risk, risk that a given security or asset cannot be traded quickly enough in the market to prevent a loss. Market risk, risk that the value of a portfolio, either an investment portfolio or a trading portfolio, will decrease due to the change in value of the market. Risk factors. Operational risk, risk arising from execution of a company's business functions. Reputational risk, a type of risk related to the trustworthiness of business. Macroeconomic risk, risks related to the aggregate economy the bank is operating in. The capital requirement is a bank regulation, which sets a framework within which a bank, a depository institution, must manage its balance sheet. The categorization of assets and capital is highly standardized so that it can be risk-weighted. Banks in the economy. Economic functions. The economic functions of banks include issue of money, in the form of banknotes and current accounts subject to check or payment at the customer's order. These claims on banks can act as money because they are negotiable or repayable on demand, and hence valued at par. They are effectively transferable by mere delivery, in the case of banknotes, or by drawing a check that the payee may bank a cash. Netting and settlement of payments. Banks act as both collection and paying agents for customers, participating in interbank clearing and settlement systems to collect, be presented with, and pay payment instruments. This enables banks to economize on reserves held for settlement of payments, since inward and outward payments offset each other. It also enables the offsetting of payment flows between geographical areas, reducing the cost of settlement between them. Credit intermediation. Banks borrow and lend back on their own account as middlemen. Credit quality improvement. Banks lend money to ordinary commercial and personal borrowers, but to high-quality borrowers. The improvement comes from diversification of the bank's assets and capital, which provides a buffer to absorb losses without defaulting on its obligations. However, banknotes and deposits deposits are generally unsecured. If the bank gets into difficulty and pledges assets as security to raise the funding it needs to continue to operate, this puts the note holders and depositors in an economically subordinated position. Asset-liability mismatch. Maturity transformation. Banks borrow more on-demand debt and short-term debt, but provide more long-term loans. In other words, they borrow short and lend long, with a stronger credit quality than most other borrowers. Banks can do this by aggregating issues and redemptions, maintaining reserves of cash, investing in marketable securities that can be readily converted to cash if needed, and raising replacement funding as needed from various sources. Money creation. Whenever a bank gives out a loan in a fractional reserve banking system, a new sum of virtual money is created. Bank crisis. Banks are susceptible to many forms of risk which have triggered occasional systemic crises. These include liquidity risk, credit risk, and interest rate risk. Banking crises have developed many times throughout history, when one or more risks have emerged for a banking sector as a whole. Prominent examples include the bank run that occurred during the Great Depression, the U.S. savings and loan crisis in the 1980s and early 1990s, the Japanese banking crisis during the 1990s, and the subprime mortgage crisis in the 2000s. Size of global banking industry. Assets of the largest 1,000 banks in the world grew by 6.8% in the 2008-2009 financial year to a record $96.4 trillion, while profits declined by 85% to $115 billion. Growth in assets in adverse market conditions was largely a result of recapitalization. EU banks held the largest share of the total, 56% in 2008-2009, down from 61% in the previous year. Asian banks' share increased from 12% to 14% during the year, while the share of US banks increased from 11% to 13%. Fee revenue generated by global investment banking totaled $66.3 billion in 2009, up 12% on the previous year. The United States has the most banks in the world in terms of institutions and possibly branches. This is an indicator of the geography and regulatory structure of the USA, resulting in a large number of small to medium-sized institutions in its banking system. As of November 2009, China's top 4 banks have in excess of 67,000 branches, with an additional 140 smaller banks with an undetermined number of branches. Japan had 129 banks and 12,000 branches. In 2004, Germany, France, and Italy each had more than 30,000 branches, more than double the 15,000 branches in the UK. Regulation. Currently, commercial banks are regulated in most jurisdictions by government entities and require a special bank license to operate. Usually, the definition of the business of banking for the purposes of regulation is extended to include acceptance of deposits, even if they are not repayable to the customer's order, although money lending, by itself, is generally not included in the definition. Unlike most other regulated industries, the regulator is typically also a participant in the market, being either a publicly or privately governed central bank. Central banks also typically have a monopoly on the business of issuing banknotes. However, in some countries this is not the case. In the UK, for example, the Financial Services Authority licenses banks, and some commercial banks issue their own banknotes in addition to those issued by the Bank of England, the UK government's central bank. Banking law is based on a contractual analysis of the relationship between the bank and the customer, defined as any entity for which the bank agrees to conduct an account. The law implies rights and obligations into this relationship as follows. The bank account balance is the financial position between the bank and the customer. When the account is in credit, the bank owes the balance to the customer. When the account is overdrawn, the customer owes the balance to the bank. The bank agrees to pay the customer's checks up to the amount standing to the credit of the customer's account, plus any agreed overdraft limit. The bank may not pay from the customer's account without a mandate from the customer, e.g., a check drawn by the customer. The bank agrees to promptly collect the checks deposited to the customer's account as the customer's agent, and to credit the proceeds to the customer's account. The bank has a right to combine the customer's accounts, since each account is just an aspect of the same credit relationship. The bank has a lien on checks deposited to the customer's account, to the extent that the customer is indebted to the bank. The bank must not disclose details of transactions through the customer's account, unless the customer consents. There is a public duty to disclose. The bank's interests require it, or the law demands it. The bank must not close a customer's account without reasonable notice, since checks are outstanding in the ordinary course of business for several days. These implied contractual terms may be modified by express agreement between the customer and a bank. The statutes and regulations in force within a particular jurisdiction may also modify the above terms and/or create new rights, obligations or limitations relevant to the bank-customer relationship. Some types of financial institution, such as building societies and credit unions, may be partly or wholly exempt from bank license requirements, and therefore regulated under separate rules. The requirements for the issue of a bank license vary between jurisdictions but typically include minimum capital ratio, fit and proper are requirements for the bank's controllers, owners, directors, or senior officers. Approval of the bank's business plan as being sufficiently prudent and plausible.